What affects your credit score? We're going to talk a little bit about credit reports, because credit reports obviously are they're your bread and butter. They're what the credit score is taken from. So I'll explain that a little bit about it, how to manage it, and then also to improve your score. And we'll cover that in a very timely manner as well. All right, so basically, where do the information sources come from? So when your credit reports are being, information is being sent to credit bureaus, the 3 major credit bureaus, which we'll cover coming up here. Who is sending that information, and who also wants that information? And the answer is all the above. One of the biggest misnomers in the whole credit report world is that this information must be sent to them. And that actually is not true at all. This information is all sent free will. They might send it, they might not, but from your financial institutions, your retail stores, medical, typically when it comes to medical debt and the credit institutions and the medical institutions, collection agencies, and then public agencies. This information is sent to the credit bureaus on their own, as I mentioned, on their own free will. There's no law that says that information must be sent. And that goes for positive information and negative information. And so people ask me all the time, well, why is it then that these institutions will send this information on free will? And the answer is because they want, when they try to pull this information, for it to be as most robust information that they can get. So they have to be a part of this situation. They have to be a part of the solution, which is to send the information positive or negatively. Now, does that mean that everyone is sending that information? No, because it does cost them. It's not free. And so I will say the credit bureaus, they are not government entities. They are for-profit institutions. And we will cover that a little bit more as we go on. Why does the credit matter to you? And let me also tell you, as we went in, as much as it is the retail stores and those financial institutions that are sending that information, you know, these credit bureaus were not built for you and me. They were not built for the consumer, as much as we might think that. It was built for the retail industries, the financial institutions. Really, they're marketing institutions. The bureaus are marketing. They sell information about us all the time. And if you guys, I'm sure you're all familiar, you go to your mailbox every day, you're getting plenty of junk mail, and you're getting all kinds of offers. You're getting all kinds of pre-qualified credit card offers, or you want to, you know, new refinance your house or refinance your car. Those don't happen by accident. Those institutions are getting information from our credit bureaus about us. They know exactly who we're working with and who we have our accounts with, and they want a piece of the action. So that's how we get the marketing that we do. But why it matters to us so much is because our credit affects so many things. The interest that we pay for things, whether we have to put down deposits for things like utilities or a cell phone, gosh, anything that you want to purchase or get a line of credit. If you have to put down a deposit for those kinds of things, that typically means you either don't have any credit or your credit's not very good, which is interesting, because these people and these organizations want to extend us credit. They make a lot of money doing it. That's how they do it. But it also affects things like job offers. Now, that's different in each state. Every state has different laws. Like, for instance, the state of California cannot, an organization that is extending a job offer cannot, during the interview process, just ask you to look at your credit report if you are going for a regular job, unless it might be you're for a management position or you work with money. So if you are if you work in the world of finance of some kind, they will be doing that. If you want to work in law, the law industry, they will look at it for that. They can as well. But for a typical position that is not management, they can't look at that. But for those other positions, they can. Are there any questions on that so far?
No questions so far.
Nothing. All right, let's move ahead. Just to give you an idea, what is the credit report? The credit report is a record that lists all past, present debts and of their repayment. And if you guys have looked at your credit reports, you know that they can be full of information. In fact, a little over the top even. And sometimes they can make your head spin because there's so much information. Because that is the information that is being sent out. Really, they know everything outside of your basically your social security number, which they cannot see. But they can see where you live, they know your name, they have surnames, different names you go by, all those kinds of things. The credit score was created by an organization called Fair Isaacs, and it is commonly known now as FICO. Now, there are literally hundreds of different types of credit scores out there. You can look online and you can look for your free credit score, and trust me, you can probably find it. But the reason the FICO score is so important is because literally 90 to 95% of all institutions that are pulling your credit for whatever reason that you're allowing them to pull your credit for, they're pulling a FICO score. And that FICO score is typically between the score of 850 being best and 300 being as low as you can get. I have only seen an 850 a couple of times in my life, and since I've been doing this for over a decade and a half, and I have never seen a 300. In fact, I've never seen a score in the 300s. So I've seen some in the 4s and quite a bit in the 5s, but definitely not in the 300s. That credit score is basically a statistical model that assesses all the information that is on your credit report. They do not typically go together. However, a lot of the different credit reporting agencies, or the bureaus as they're known, they have their own independent scores as well, but that is not what typically the organizations that are pulling your credit are looking at. The FICO, as I mentioned before, it was Fair Isaacs Corporation. They rebranded about 5 years ago to where FICO is on everything, where it used to be just Fair Isaacs. But as you can tell, they've been around quite a long time, and there's a reason that they are the leader. You'll see us talk about a Vantage score coming up here. That is something that you can find on Credit Karma. That was actually created by the 3 different bureaus, and it is probably the biggest competitor to FICO, but it is not even close to the FICO score. As I mentioned, there are the bureaus. There is Equifax, TransUnion, and Experian. You probably have heard a lot about Equifax in the last number of years because there was a huge breach when it came to in cyber world, and millions of people's information was hacked, including my own. And Equifax then bought all of us who were in that information. They didn't buy it for us because they own it, but a credit monitoring service for more than 5 years. That would basically, anytime anything that comes up a little bit fishy or irregular, like there's irregular purchasing, that information would be emailed or texted to us. And in fact, you can find these anywhere. The great news is a lot of banks and credit unions have this as well. In today's world, the Visas and MasterCards and your banks are very good at finding irregularities with purchasing, and they will notify you. So they really have come a long way with helping us know exactly what is going on in our credit profiles. As I kind of mentioned before, that there's all kinds of things that are on your credit report, including your name, address, social security. The only time, and I want to preface this, there are differences in if an organization is pulling your credit report, it looks different than what you are looking at for your own purposes. And it's very important that you look at your credit report, not just check your credit scores regularly, but to actually look at the credit report, because the credit score doesn't tell you the whole picture. But what the credit report has, and it's in different sections, is all of your identifying information. It'll have your current address, but it'll also have past addresses, which is interesting. I was looking at my credit report again just a couple of weeks ago because there was some irregularities that I thought my credit score was a little funky, and I wanted to know why. And it still had addresses of places I lived when I was in college back in the early 90s. So I can have that removed. It really doesn't bother me. in that case, but it does show where you've lived, and typically that's where you're getting your mail. Public records. Public records consist of things that are typically legal. Bankruptcies, tax liens, if you owe money to the government because of back taxes, that information is all public record. Foreclosures, if you've been foreclosed on. Wage garnishments is typically when an organization takes you to court because you didn't pay a bill, and if the court finds you that you do in fact owe that, they can garnish your wages. Which, by the way, they don't even have to contact you about it. That'll go right to your HR department, and they are legally bound to garnish your wages without even letting you know. Typically, HR will have that conversation with you, but they don't have a choice when it comes to that. If you've ever been sued for anything, if you've been in an accident and your car insurance, for instance, doesn't cover the amount that, let's say there's somebody else that was in the accident and they were injured pretty badly, and your insurance only allows up to a certain amount for coverage, and they sue you for the rest, that information is public record. And typically a judgment will be found against you, and you'll pay so much over that period of time, for a certain period of time, kind of like a loan, but that information will be there until that has been paid off. And then again, like any other judgment. Now, if you don't have any public records, that part of the PDF that you'll look at will be blank. There will be nothing there. The real bulk of your credit report are the credit accounts, but they're known in our world as trade lines, which includes any credit card accounts. It includes any kind of like auto accounts. If you have a mortgage, if you own property, if you own apartment complexes, or you even own corporate retail space. All that information will be there. Anything you make payments on in a month outside of making payments to a family member or something who is not reporting this information, it typically will be found on there. The difference and the good information and a good reason for this, these trade lines, and we're going to talk about this a little bit in the future, is typically those accounts that you're paying monthly on, they send positive information. So if you're making payments on time every month, that positive information is being sent, which is building your credit. You want that. You want people to send that information. But there are other things which are considered credit that are not being sent on a regular basis. However, there is Experian who has tried to come up with Experian a Boost, which for things that we make payments on a regular basis, like utilities, rent, those kinds of things, which are typically not attached to your credit scores, your FICO score. However, there are differences in that as well. Currently, most people are looking at FICO 8, but FICO is constantly trying to upgrade and improve their credit scoring system. But again, all these retailers and different organizations can use the type of scoring model that they want. And then also, because as I mentioned before on your credit report, that it is also a marketing is inquiries. Now, there are hard inquiries, which a lot of people hear that if I look at my own credit report, that's going to hurt my credit score. Couldn't be farther from the truth. You could look at your credit report every single day if you wanted to, but that could get a little expensive. But the only time that is considered a hard inquiry is actually when you go to open up an account for yourself and they are looking at your credit for that purpose. That is what's considered a hard inquiry. Now, that is not affecting your credit a lot. I'm going to talk about that here in a second. So don't worry about that. Don't think that your credit's going to get hurt and ruined because you go to open up another account. Now, if you're opening 5 or 6 accounts at one time, is that a red flag to this industry? Yeah, a bit, but it's still not a huge thing. Then there's soft inquiries, and you can actually go to your credit report and look at all the different organizations that are looking at your credit, report for marketing purposes. They want to offer you different types of loans. They want to offer you different types of offers, pre-qualified credit cards. That's what they're looking at. And you can actually look at all those organizations and see who has been looking at your credit for those purposes. That has absolutely nothing and no bearing on your credit score at all. In fact, and again, soft inquiry is you looking at your own credit score, or excuse me, credit report, they can, and you can see how many times you've looked at it actually. As I mentioned, how the credit score, this is what FICO looks at. They're obviously never going to give the formula or the rest, mom's old recipe or grandma's recipe, so to speak. But they do tell us what our actions, what we do, what affects your credit score. So this can tell us a lot. This can tell us why maybe our credit score is bad, or it needs improvement, or it can tell us why we're doing such a great job. It can also tell us these are the things that you need to do to improve your credit, which we can talk a lot about here. Again, if you have any questions while we're going, please let me know, and I will try to answer those as we go, especially as we're going through this. I want to make sure that we get everything covered.
Hey, Chase, we do have one question.
All right.
It says, I've been paying off my debts and paying other bills on time. How long does it take for a credit score to improve?
Actually, that's a very, very good question. And that also depends on a number of things. It depends on what your payment history was up until you started paying all these things on a regular basis. It also depends on, as you can see over here, 30% much, how much you owe. So how much debt are you carrying compared to how much of credit is available? So how much credit is owed is very, that's an interesting, the way they put that, because it's not just about how much you owe, but how much credit's available to you. So there's a ratio in there. So basically, if you're starting to pay it down, let's say you had just to make it simple, you had $1,000 available credit to you, and you have $700 of debt that you're trying to pay down. So that means how much you owe is at about 70%, which is not a good ratio, right? That's a terrible ratio. That means that you have way more debt than you have available to you, but the more you pay that down, so if you're paying that down on a regular basis and you're not adding to that ever, and that is going to see that ratio improve. So that's going to help improve your credit over time. Also, payment history, as you can see, that's 35%. If you're making payments on time on a regular basis and you're punching in getting rid of chunks of that how much you owe, you're going to see your credit report improve significantly over a period of time. Now, can I tell you that it would improve in 6 months, a year? And without me looking at your initial your complete situation, I couldn't tell you that. But I can tell you that if you keep that up, it's going to improve on quickly, much quicker than and believe me, it's if you're not adding to it as well. But that is a big part of it. Are those two things: your payment history, make your pay. If you want to build credit, it doesn't matter, by the way, if you put $500 on your credit report or on your credit card and pay it off, versus if you put $10 on your credit card and pay it off every month. They just want to see that you're using it and that you're paying it every single month. And when you do that, that is going to improve or build your credit relatively quickly. But the biggest part is, if you've heard about maxed out, you've heard that term. The more that you can bridge that gap between how much you owe and how much you're paying back, that's a huge thing. And that's why, believe it or not, credit cards are the biggest thing that you want. And this sounds backwards, right? You want to build credit, you have to have credit. The credit cards are the fastest way because there's a real clear picture on what your capacity is and how much you pay back every month. That's a real big factor. When it comes to auto loans and your your home loan that you have, your mortgage, there's not a real ceiling there, right? They know how much you originally took out, but what they're looking at more is, do you pay it on time? Because the value of your home is going to change all the time. But so what they'll do is they're going to look more at what was the overall loan for. I hope that answered your question. If you have any others, keep them coming. Hey, Josh, I don't know why you could see that. I could see the little hand come up, but I couldn't see, I can't see the messages or the question in the box.
Okay, no problem. We did have one other question. Someone was wondering what the other factors are on this graph.
Yeah, and I was going to get to that. So the other factors are basically, those are inquiries, all right? Those other factors are how many times are you going out trying to get credit? There are people that are starving for credit, want to get it a lot. they go out and they will try to open up any accounts they can, whether that be just going down to the mall and going into Banana Republic or Macy's or whatever, and they're just trying to get credit any way they can for the sake of building credit or just being able to purchase. And that throws up red flags. So the more often that you are trying to get credit, that's that little 10%. But as I mentioned earlier, don't let that affect you from going to car shopping, for instance, is a great example. You might, I just did this in February. I went to many different, I was looking at different trucks. I was looking at different places to get them. I went into my credit union. I went into other places to try to get the best rates I could. So they were all looking at my credit report, but they were all looking at my credit scores and pulling credit for the idea, for the purpose of me purchasing a car. So if I did that in a 2-week period, let's say, the industry looks at all those pulls of credit as one pull. So it didn't affect my credit. But when you're trying to pull credit for lots of different, and if you were looking for the same thing for a mortgage, and you're going and you're shopping around for better interest rates from people, which you should, by the way. Same thing with credit cards, same thing with all the different things. Shop, don't just purchase something or get a loan at face value because somebody wants to loan it to you. There are a lot of things that you need to look into. So that's what other factors are. New credit, that's kind of the same thing. When new credit is when you go out and you're buying and you establish new credit, or a new loan, right? So a very good example of this is there anybody out there, and you guys can raise your hands, I think, but have you ever gone through the process of buying your own home, and going through the process of going through the mortgage industry? Because if you have, you know that once you get into escrow, right, your loan officer will tell you, all right, from here to the time that we go to closing, do not buy anything. Do not go put anything on credit. Don't go purchase anything, because that can have a major factor, right? You go out and you decide, oh my gosh, I'm so excited to buy my new home, but we need furniture to fill it. And we go out to Jerome's and we throw $10,000 worth of furniture on there. That's a big hit to how much you owe. That's a big hit to your debt to credit ratio. So that can affect very quickly your credit score. Right now, does that mean that because you put $10,000 on it, that's going to affect it long term? No, but it can affect it in the short term. And that short term and then they go to pull your credit again right before they go to close. Now all of a sudden you went from a 790 to a 720. That could have that could be a whole point on your go from a 3.99 interest rate to a 4.99, and that over a 30-year loan is going to have a huge difference on the amount that you pay, not just monthly, but over the period of the entire loan. Did that answer everybody's questions on that? Length of credit history. Look, there's nothing you can do about that. The longer you've had credit with certain institutions, anybody ever told you not to close a credit card, even if you didn't use it much? And a lot of that, sometimes people go, well, I've had that one forever. I don't use it much anymore. I'm just going to get rid of it. Well, there's no reason to do that. If you do that, what that can affect is all that history of credit that you had with them, right? That history of good payments, all that kind of thing. The longer that history is there. So if you're ever going to get rid of a credit card, let's say you have 7 of them and you don't want 7 anymore. I agree with that, by the way. A really good area to have really good credit, kind of that sweet spot, anywhere from 4 to 5. But get rid of the newer ones. Don't get rid of that history. That's an important part. Josh, I think I saw hands going up, but I can't tell.
Yeah, we did have a question regarding credit cards. Is it prudent to increase your credit limit with a credit card company that keeps asking you to increase your limit by reporting your income?
That's a great question. And the answer is twofold. There's 2 sides to that. Do you know the kind of purchaser you are? Believe me, they want to give you more credit. They want to give you more available credit to, increase your shopping ability or increase your purchasing power, which is a big marketing term. Know yourself. Yes, if you increase it, that's going to help that's going to help that credit ratio. That's a good thing. But if you are the kind of person where your credit card burns a hole in your pocket, or your purse or your wallet, and you know that you're going to add to it, then that might not be the smartest thing. But if from a critical standpoint, from a smart standpoint of it trying to improve your credit, you put things and you purchase something on your credit report or credit card, you pay it off every month, that's going to be great because now you have more available credit to you, which is going to improve your overall credit. So it's twofold. The most important thing I tell kids, the most important thing I tell people is you need to know and understand your own love affair with money and credit. Because if you are one of those people that just loves to buy and you have the ability there because you have the credit card there and you know that you're not able to pay it off at that month, or you know you don't have a plan to pay it off in a certain amount of time, then maybe you ought to question whether you raise that limit or not. Otherwise, if you come up with a plan, for instance, there's these great examples of, you go into Best Buy and they'll give you 24 months of interest free, right? 24 months, you buy a great laptop for $2,000 and they give you 24 months to pay it off interest free. Do the math, come up with a plan. You know you're going to pay a certain amount every month. And you pay it off before then, that's a great idea. And you should do the same thing whenever you purchase anything else with a credit card or you take out another loan by chance. Great questions. Just the idea, kind of what a person with, if they were to get the exact same thing, buy the exact same purchase for, let's just say they went out and bought a laptop for the exact same amount of money, and yet their credits was different. John is going to pay more than Jane when he has a 620 credit score versus her 750 for the exact same product. And Jane's going to save a lot more money just because her credit score is so much better. So that's why it's so important to really be on top of what your credit score is. Shop around, because look, not everybody, CalCoast may have a different guideline for what they consider great credit versus what another credit union or a regular bank might offer. So it's really good to shop around. And believe it or not, and I'm not saying this because this is CalCoast, but credit unions in general are going to be much better to work with when it comes to those kinds of things. As I mentioned before, that the credit report was not built for us typically. So nobody else is actually monitoring your credit report for your good nature than you. You need to look at it. We are responsible for our own credit reports. The government realized this in 3 decades ago and came up with a solution. And basically they came up with a website that you can go to called annualcreditreport.com. If you're not familiar with this, the credit bureaus by law have to offer a free credit report for you to look at every 365 days a year. And that's not just one, that's one from each of the 3 credit bureaus. So I recommend highly that you do that. I even pay, believe it or not, actually, your banks and your credit unions, they actually can offer you different solutions to look at your credit reports for free as well, just so we can really, so you know that there's not mistakes on your credit report. There's literally mistakes on 1 out of every 2 credit reports. On 1 out of every 3 credit reports in the United States, there are big enough mistakes to have major effects on your credit rating. And that can simply be just misidentification. There are a lot of kind of normal names in this world. If you're a Smith or a John or a Martinez, I mean, there's a lot of those kinds of names. There are going to be mistakes. There's going to be mistaken identity. So really, it's important to take a look at your credit reports to say and show, okay, are all these mine? And that's important. I mean, my brother and my dad and I all have the same 3 initials, and I get my brother's and my dad's stuff on my credit report all the time. Thank goodness that's all positive. All right, so basically, one thing I want to go over real quickly here is in this period that we find ourselves in, if there are situations where you've been laid off, or your pay has been taken back a little bit because you're not working as many hours, and you're just trying to get yourself back, the biggest and most important thing you can do is go to your institutions and explain this to them. Tell them that you've been laid off. There's stress that you're not able to cover all of your expenses at this point. And these organizations who are really good at CalCoast, I have a car loan with them. They just, right when this thing happened, we were wondering why we had so much money in our account. We had to go look all of a sudden, and that's because they basically gave us 2 months off. to basically say, here's some relief. We're not going to charge you your car payments this month for these couple months. So that was really, really great. But the most important thing you can do is don't just not pay it and say, forget it, I'll worry about it later. Go to your institutions, let them know. And if you work with them, chances are, I can almost guarantee you, in fact, the law said it, part of the CARE Act, is they cannot report information if you have discussed that you are being affected by COVID-19 and the pandemic. So that is really, really, really important to have that conversation. I know it's a pain in the neck. You don't want to get on the phone and discuss that kind of stuff, but it's super important because they are there and they are ready to work with you. Also a good place to go look at your information. Again, I mentioned Credit Karma earlier. This is a great free way to monitor your credit. But again, you are not looking at a FICO score. FICO, it's going to cost you. They're going to charge you $10 or so to look at your credit score. But there are also a lot of banks and your credit unions are offering this as well. They'll give you your credit scores for free as well, just if you want to find it. But these are great places to go. If you're looking for different credit cards and you bank with in a great institution, go to them and find out what are the different options that you have available to you, because not all credit products are created equal. There are many, many different types of credit card products that are out there from each institution that are there for specific reasons. If you are a business person and you're a business traveler, then there might be a credit card that they have that works with a different airline that will give you lots of points for airline miles or give you lots of free flights, whatever it might be, then that will work for you. But there are, as I mentioned, work with them. Don't just take any kind of credit card offer that comes your way. Look, and a great thing to do is go to your institution, or you can look at like credit.com. There's a couple websites out there, creditscore.com, and Credit Karma, by the way, that will give you different scenarios on what great options are for whatever you're looking for. Let's take it and let's open it up to questions. Anything I haven't answered, let's just have at it.
All right, so first question is, how do student loans affect your credit?
Student loans in themselves affect your credit in this way. If you pay, well, okay, a couple ways. When you get your loans, all right. So if you were to get a loan, your typical government loan that you would get, that loan will now be on your credit report, right? But it'll also show that your payments are being deferred until you graduate, right? Well, once you graduate and then you go that 6 months, and then you have to make payments on them. Once you start making payments on them, that's really going to start. They're great for your credit score because you're making payments on an account. Like any other account, if you stop making payments on them and you don't work with your servicer on a plan of some kind, and you just go delinquent, they're going to send that information. And when I mean delinquent, that means if you go one full month, or what they call a billing cycle, right? That month isn't necessarily the 1st through the 30th or 31st. That could be whatever the date is that you owe, and when your account closes and then you have to make that payment, that's called a billing cycle. So if you're familiar, and you might have, let's say if you don't have one servicer on your loans, and you have 4 or 5 different services for different loans that you took out, they might all be due at different times of the month. So they all have their own billing cycles. Once you go an entire billing cycle, and then you're going to owe double on your next payment, that information, you're considered delinquent. And if they choose to send that information, that will be a negative mark on your credit report. But if you're making your payments on time every month, that's going to improve your credit. But that's the same with all different loans that you have. Now, if you put them in deferment, meaning you go to your servicer and they're telling that you work with them and you're putting it off for, let's say, as you're unemployed, and they give you 24 months reprieve, and you're not paying, that's going to say that on your credit report. It's going to say that you have your payments deferred. So it won't have any effect, but it's not building your credit because you're not paying at that time.
All right. Also have a question about a COVID federal EIDL loan, how it affects your credit. And it's a 30-year loan, so I guess it's a long-term loan. Do you know?
A long-term loan. Yeah, it's going to work very similar to any other loan. There are other factors. If like most loans, if you stop paying and you're not paying as you are contractually obligated, then it's going to affect your score. Anytime you're not paying on something, it's going to affect you. Unless, of course, that information isn't sent because you worked it out with your servicer. Now, and also it's going to show that you took out the loan. So it's going to be, you have this amount that you owe, and it's going to show that. So when you first take out the loan, will it be a lump sum, and then will your credit score go down a little bit because you've taken out a new loan? Yes, but only briefly. Once you start making payments on that, you will be fine. Also, let me put it to you this way. If there are loans, like there are many different, like for instance, loans that will be forgiven. A lot of that came out in the CARE Act. If you're a business owner and they give you a loan for COVID-19, if it's forgiven, then it will show that on your credit report. So it will not affect you in that way, just because when you stop making payments. But again, if for some reason they are still reporting that and you catch it, and you have, one thing I will recommend very, very highly is keep any loans that you have that you're making monthly payments on, or you get any correspondence that you have been relieved of a loan of some kind, keep all, it's like your taxes, keep all of that information in a safe place for up to 3 to 5 years, just in case something comes back to bite you. That's not your fault. There's an organization that just, there's mistakes made all the time. A lot of this stuff's automated, so it doesn't get reported. Make sure that you're on top of it.
Right. The next question is, does it negatively affect your credit score if you close a credit card that you have but continue to make payments?
Yes, it can. And what you're saying is, if I remember, if I'm getting this correctly, you have a credit card that you are paying back, but it has been closed by yourself or the servicer for whatever reason it might be. Yeah, because now the initial, well, actually it's twofold. If it's closed and you have a lot of available credit and you don't have much debt on there, and they close it, then that's going to go against your total overall credit ratio, right? What available credit you have versus how much you owe. If it's closed because you have a lot of debt on it and very little room left to purchase, it's not going to have a major effect from where you are already. Okay, so just closing it doesn't have the effect, right? If it closes and all of a sudden you go from $15,000 available credit down to $10,000 available credit, and you owe $5,000, you went from 30% ratio to a 50% ratio. That can affect your credit. Does that make sense? I hope so. I can't tell whether you're nodding or not.
All right. Which credit bureau weighs the heaviest on credit decisions when applying for credit?
It doesn't. They're all equal. They look, and this is what's interesting. You'll find, and you'll see in commercials a lot, that you have different credit scores for different credit bureaus, right? You might have 3 different FICO scores, and that is absolutely true. You'll have a FICO score based on your TransUnion. You'll have a FICO score based on your Equifax and on your Experian, but not because they are different or one is better than the other or one has a more, better information. What it comes down to is what information is on it. Not all organizations send to all 3 bureaus. Some organizations just have a working agreement with Experian, so they might just send their information to Experian. And what's interesting about that is you might apply for credit, and you might have much better credit score at TransUnion than you do on your Equifax and your Experian. But if that organization that's pulling your credit pulls your TransUnion FICO score, lucky you, you're going to get the better rates, right? Because that credit is on there. Now, typically the major banks, your auto loans, whoever has your mortgage, they are going to send that information to all 3. But institutions like, for instance, Sprint, I know that they used to, and I don't know what they do now. I should look into it, that they have combined with the other T-Mobile, I believe it is. I don't know if they send all 3, but it used to be that Sprint would only send it to Experian. So, and I don't know if that's the case anymore, but different services are going to send to different organizations or different bureaus. But one is not heavily weighted over the other.
All right, next question is how do I obtain auto financing with bad credit?
Okay, well, that is a very interesting question. First of all, you can find, I'm going to say this for all lending. If you have bad credit, you can still find somebody that will give you a loan. That being said, not all loans are created equal. Look, there are subprime, they call it, in the industry, they call it subprime. Typically into the low mid 600s and below, typically lower 600s, that's going to be considered subprime lending, and they're going to be organizations that literally that's all they do. So if you want to purchase a car, typically you can go to one of those, you can find them where it'll be an independent, smaller, and it could be large or small, but typically an independent car lot or financier. You can find them online, especially if it says no credit, bad credit, no problem. Typically I tell people to stay away from that because they're going to give you a loan, but the terms are not going to be in your favor at all. They are going to, it is going to be a huge interest rate. I had a student right before we went on this thing, I was doing this presentation, and I had a student that was just literally shaking his head in his desk, and he'd said, oh man, I didn't have any credit. And I went to this, and he was paying a 24% interest rate for a car. He was literally paying twice as much in interest than he was for the overall car. So you can find loans, but I caution you. Just because you need, I mean, it can be more, it can have more of a dramatic effect on your overall financial health by getting that car, especially if those loans are typically for used cars, and a lot of those cars are sold as is. So there's absolutely nothing to back you, right? There's nothing to protect you from that car being a lemon because they sell it as is. So you might be paying this crazy interest rate, which is making your monthly payment a lot more than it normally would be. And then your car breaks down and now you owe double. What are you going to do? So realistically, even if you have back, I would go to your credit union. If you're a member, go to talk to them. Tell them what is their line? What is it that they're comfortable with in giving a loan? Because typically these organizations, these type of lenders are not going to give you outrageous car loans or other types of loans. Typically you want to stay away from those places that say no credit, bad credit, no problem. It's almost better to try to figure out how to improve your credit over a short period of time, because long-term, or help get a cosign from somebody in a family or a friend that can help you with a lower interest rate. Otherwise, it can have a much more profound negative effect long-term. Great question, though.
All right, and the next question is, what type of careers would you be disqualified for with bad credit or bankruptcy?
That's a very loaded question. I can't answer that altogether, but I know as a whole, typically law enforcement is a big one. If you're border patrol or you're looking to go in to be a police or FBI or something like that, if it's a government position where you are able to look at important or sealed information, if you're working with money, if you are in an industry where you are doing payroll or you are doing any kind of financing at all, that's going to be an industry where they're going to, and I'm not going to say you're going to be knocked out, but they can look at your credit report or credit score to make a decision on those factors. And typically, there's numbers of reasons for this, but typically it's if you're having financial troubles and you're going into something like that, they want to try. It's a stressful enough job, and if you're having financial stress at home, and you have this stressful job, you could be more susceptible to being paid off. You could be more susceptible to taking payoffs, those kinds of things. But that's typically the industries. That's not the only reason. There's many others. And again, every state's different based on that. So if you're going for a position that isn't a major management position or doesn't, that will not factor into your hiring in the state of California. So you shouldn't worry about that too much. And by the way, all different organizations look at bankruptcies and look at foreclosures or something like that in a much different light. If you have a story for it, you got a specific reason for it. Again, documentation is important. not all organizations are going to be just blank. If you have a bankruptcy, we're not going to hire you. That's just ludicrous, especially depending on how old it is. And I want to mention that for all reasons, if you've had bad times in your life where you've had, financial misfortune, the older that information gets on your credit report, the less weight it carries. So just because it's there, let's say, your bankruptcy's on there for 10 years, you get into year 4, 5, 6, it's going to carry a lot less weight than it did when it first happened. And that goes for all of that information that's on your credit report.
All right. Is there any way to obtain credit without using credit cards?
Very difficult. And I will tell you why. Well, yes, there is. If you were wanting to purchase a car, and somebody, a family member or somebody that's really close to you is willing to co-sign for you, I personally don't recommend. If you're asked to be the co-signee, that's very dangerous, because that co-signee is just as responsible for that debt as you are. So if somebody co-signs with a car that you are trying to purchase, and they co-sign with you, and even though you're the one that drives it and you're the one that's making the payments, if you don't make that payment, they're not just calling you, they're going to call the other person that's on that loan, because they're just as responsible for it legally. That being said, when somebody co-signs, that information, that account is now going on your credit report. And once you start making payments over time and you're on time every month, then that will slowly build your credit. But unfortunately, just the way the system works, the way it is right now, credit cards are going to be the fastest way. Now, that being said, FICO has had something called FICO 9 for quite a while now, which has kind of changed a little bit the way they look at it. They're constantly trying to create their models based on what the purchasing and the backgrounds and the way people are using credit in this day and age. FICO 9, for instance, states that if you had medical bills and you didn't pay them, that used to affect on FICO 8, that would affect you just like you had a delinquency on a car payment or a credit card bill. But now, because they realize that medical bills are sometimes, they're not your fault, and that doesn't necessarily reflect the way you handle credit, they are factoring those in much, much less now. But it also, in that same manner, they are also looking at rents and those kinds of things. The problem with rent and bills and utilities, they don't typically send positive information that you're paying monthly. They only send old information. So I got a little bit long in the tooth there, hoping to answer the question thoroughly, but I hope that answers your question. You can, It's harder.
All right, for the sake of time, we have 3 more questions. We're going to go rapid fire. Ready, Chase?
Perfect. Yep.
All right, first question. Can student loans be forgiven?
They certainly can. And that's where you need to go to your servicer. You need to discuss that. There are all types of different forgiveness depending on your situation over periods of time. In fact, there are 6 different kinds. I recommend heavily that you go to Department of Education and look into that, because there are many, many different ways, both through the government, that you can look at that, especially if you are a teacher or you work in certain industries within, if you work for nonprofits, for instance, or if you work in different specific organizations, there's many different kinds. There are different factors. So yes, they can be forgiven. Will they be? It depends on your situation.
All right, question number 2. Do you recommend using credit repair companies?
I would say that depends on your situation. If you are looking for a pot of gold at the end of the rainbow, and you're expecting miracles, any organization, any credit report or any credit repair agency that guarantees you that they'll fix your credit, I'd be very, very apprehensive. But there are some legitimate great ones out there, but they'll be honest with you, looking at what you owe and say, look, there's a good chance that we can get 40 to 50% of what's on here off. And typically that's because they look at it and they know that there's old information, there's misinformation, and they work with the servicers all the time. So they're really good at working with this and getting stuff knocked off, but it's not a miracle. They can't work miracles. If you owe debts and you owe, and the information that is on that report is legitimate, they can't just wipe that off. But there are some really interesting things that they can do. So I would just look into that. At the San Diego Financial Literacy Center, we actually have a few different organizations on there that we respect very, very much. But I wouldn't just, again, like anything else you're going to use, shop around and see who you feel comfortable with. And if you want, you can go to the SDFLC. Those are, we can talk about that kind of stuff. Look at your credit reports and the actual credit professionals at CalCoast. They have people that can do that as well.
All right, final question. What is considered a high interest rate for a credit card versus low interest rate?
Oh, that's phenomenal you asked that. The interesting thing is as far as legitimate loans go, your everyday credit cards, and those credit cards are the worst loan you can get by far. And if you look at this, a good interest rate for a credit card right now, and it's been volatile right now. The other reason that credit cards aren't great because of interest rates is typically because of what happened in 2008. Credit card, they're typically variable interest rates now, so they go up and down with the stock market, or not with the Federal Reserve, excuse me. And so they're not fixed like you would have in a mortgage or a car loan or personal loan. But a good interest rate is typically around 10 to 12%. Very rarely do you see interest rates in the single digits nowadays. A lot of us might have them because we've had long-term relationships with them. So, again, like anything else, they want to keep you if you have good credit, they're going to stick with you. But typically we're seeing new credit cards right around 14 to 18%, depending on the credit. Retail store cards, or what we would consider non-traditional credit cards, store cards, they're typically going to be a great interest rate for them is 18%. Typically, you're going to find them in the 24 to 26%, which is awful. I wouldn't recommend that at all. But you're doing good if you're getting a new credit card anywhere between 12 and 15%, which is not great. But when you consider that a home loan these days typically is around anywhere between 3.5 and 4.5 for or a car loan. A really good car loan for a great credit is right around 2.5 to 3.5. And you can even find them in the ones. That ought to tell you something.
All right. Well, I want to thank Chase for presenting today, and thank everyone for joining us. We're going to stick around for a little bit longer to answer any more questions that you may have. But I would definitely encourage you to either visit calcocu.org. We have a lot of great resources there, both COVID and non-COVID related for financial wellness. Or you can also visit SDFLC, that's San Diego Financial Literacy Center, SDFLC.org. And they have some great resources and different webinars and things like that as well. So a lot of great info to access if you need it. We're always here for you. We here at CalCoast and Chase and his organization, we focus on financial wellness, and we want you to be financially well. So please reach out to us anytime. CalCoast actually does offer to our members free financial coaching. So you can contact our coaching team and schedule an appointment with them, either in person, well, not necessarily in person right now, but over the phone or virtually. And they can talk to you about anything financial, financially related, whether it's credit, budgeting, getting out of debt, paying off student loans, all that good stuff. So definitely keep that in mind. But thank you everyone again for joining us today. Stay safe, be well out there. And at this point, if you'd like to log off, you may. Otherwise, we'll stick around for some more questions.